Welcome back to Iron Financial, the one place where we are dedicated to forging you a stronger, more resilient portfolio. Today, we are putting a giant into the forge. Realty Income, ticker symbol O. For decades, this thing has been pitched as an impenetrable dividend fortress, the very bedrock for any income investor. But here at Iron Financial, we don't care about reputation. We care about reality. Is this fortress truly built to last, or are we about to find some serious cracks in its foundation? Let's dig in.
So everything, and I mean everything the bulls are saying today, it really hangs on this one single, very bold quote from CEO Sumit Roy. The momentum in our business is palpable. Now that's not just corporate speak. Palpable means you can literally feel it. He's not just saying, hey, things are okay. He's claiming the business is actually accelerating, that the wind is at their back. And our job today is to either prove that's true or tear that argument apart. Is this real momentum or just a nice line for an earnings call? The numbers, well, they're not going to lie.
Exactly. Palpable is a heck of a word to use. But let's be honest, talk is cheap, especially when you're a CEO on an earnings call with analysts. We've all seen this movie before, right? A CEO talks up all this amazing momentum, and then bam, the next quarter, the whole engine just seizes up. So we're going to do the heavy lifting for you. We're going to get out the blueprints, we're going to double-check the math, and we're going to see if the hard data actually supports the story. Is this real growth, or is this just a company coasting on a great reputation? That's what we're here to find out.
Okay, so here's our battle plan for today's analysis. First, we're going to tackle that legendary reputation. Is it really a monthly dividend fortress? Then we're putting on the hard hats and inspecting the 2025 foundation, getting into the nitty-gritty numbers. After that, the fun part. We're going to actively search for any structural cracks in the outlook for 2026. Then, we'll look at how they're trying to forge new growth engines to power the future, and we'll lay out their financial blueprint for the year ahead. And of course, at the end, we give you the final Iron Financial verdict. Let's get to it. All right, look, before we start swinging the sledgehammer, you have to give credit where credit is due. Realty Income has done an absolutely masterful job of branding itself as the monthly dividend company. And this isn't just some clever marketing gimmick. The track record is an absolute beast. Think about this. As a public company, it has delivered positive total operational returns for 30 straight years. Just let that sink in. 30 years. That means it survived and thrived through the dot-com bust, the great financial crisis of 2008, and a global pandemic. And they hiked the dividend every single one of those years. That history, that is the bedrock of their entire brand.
Oh, the brand is powerful. I'm not going to argue with you there. You see that logo and your brain immediately thinks two things: stability and a monthly check. But listen, that's where the danger lies. A powerful brand can create a massive blind spot. Reputation is built on the past, but we're investing our hard-earned money for the future. A fortress that isn't constantly being maintained, constantly reinforced, will eventually crumble. I don't care how famous it is. The bottom line is this: reputation doesn't sign the dividend checks. Cold, hard cash flow does. You hit the nail on the head. So let's follow the money. It's time to pour the concrete. Let's inspect that 2025 foundation using nothing but the numbers. This is where we find out if the operational machine is still firing on all cylinders. This is the pure bull case, with all the hype and narrative stripped away. And we're going to start with the most basic question for any landlord, big or small. Are your tenants actually paying the rent? And right out of the gate, the first pillar of this foundation looks like it's made of solid granite. Just look at that number: 98.9% portfolio occupancy. To put that into perspective for you, in the world of commercial real estate, anything over 95% is considered absolutely top tier. So to be just a hair under 99%, across a portfolio of more than 15,000 properties, that's just exceptional. It tells you one thing very clearly: their buildings are mission critical for their tenants. This is the first piece of hard evidence that supports that palpable momentum claim. It is really, really tough to argue with a number that strong. Now that nearly perfect occupancy, well, it flows directly to the top line. And we're talking about a lot of revenue. For the full year of 2025, Realty Income pulled in $5.75 billion. This isn't just a big, impressive number. What it really represents is immense scale. And that scale, well, that's their competitive advantage. It's their moat. It means they can get better deals, they have more negotiating power with tenants, and they can borrow money cheaper than all their smaller competitors. This number is the raw power of their empire on full display. You've all heard the old saying, right? Revenue is vanity, profit is sanity, but cash flow is king. And for a REIT like this, the king of all metrics is adjusted funds from operations, or AFFO. Forget all the accounting adjustments. This is the real tangible cash profit the business generates that it can use to pay us, the shareholders. In 2025, they cranked out $4.28 per share. This is the core engine of the whole machine. Now, what gets really interesting is how this number has been growing and what it tells us about the real health of the company. And this table right here, it tells the whole story perfectly. Let's walk through it. Total revenue, the top line, bam, it surged over 9% from the year before. That's a strong number. But here's the important part. Look at the engine, the AFFO per share. It grew by 2.1%. Now check out the dividend they paid per share. It grew by 2.9%. So the key takeaway is that the growth in their cash flow engine is what's funding the growth in the dividend. This is that beautiful, virtuous cycle that every income investor dreams about. The 2025 foundation, you have to admit, it looks incredibly solid. Okay, you're right. The 2025 numbers, they're solid. I'll grant you that. But a fortress is only as strong as its ability to handle a future attack, not a past one. My job here is to be the inspector, to find the weak points, to look for those tiny hairline fractures before they become a total system failure. So now we pivot. We're going to stop looking at what they did do, and we're going to start picking apart what they say they're going to do. And this, my friend, is where that palpable momentum story starts to feel a lot less palpable.
This is the only question that should matter to you if you're thinking about putting money to work today. The market could not care less about last year's results. It is a forward-looking machine. So when we look at the company's own guidance for 2026, what do we see? Do we see acceleration or do we see deceleration? Is this engine really firing on all cylinders, or is it starting to show signs of strain under its own massive weight? Let's take our eyes off that rearview mirror and look at the road ahead. And here is where the first few cracks begin to show up. Let's break down their own forecast. Now, on the surface, that AFFO growth looks fine. It's actually projected to accelerate a little bit. But look closer. Look at this middle line. Same store rent growth. All that means is how much they're raising the rent on properties they've owned for a while. It is the purest measure of their internal organic growth engine. And it's flatlining. It was 1.3% in 2025, and the best case scenario for 2026 is 1.3%. That's not momentum, my friends. That's a plateau. And what's worse? Look at occupancy. After bragging about that incredible 98.9%, they're now guiding for it to actually drop. It's a small dip, sure, but it is not the direction you want to see. And while those internal growth engines are sputtering, you have to look at the other side of the balance sheet. And this is the big one. Almost $30 billion in debt. That is a colossal, staggering number. Now, look, I get it, big companies have big debt, but when your organic growth is slowing to a crawl, a debt load of this size can act like a giant sea anchor in a storm. You have to start asking tough questions. How much does that debt cost to service? Has Realty Income simply gotten too big for its own good, weighed down so much that meaningful growth is now almost impossible? Okay, those are absolutely fair points, and they highlight the challenge of being a giant. The internal growth engine, their same-store rents, it's steady, but it's not a rocket ship. All can see that. But you're missing the entire other half of the growth equation. A company of this size doesn't grow from tiny little rent bumps. It grows by becoming a capital allocation machine. It grows by actively and intelligently deploying billions and billions of dollars. They aren't just sitting back and maintaining the fortress. They are constantly building new towers and reinforcing the walls. The real momentum story is in their external growth.
I mean, just look at the raw scale of what they're doing. In 2025, they invested over $6.2 billion acquiring new properties. A massive number. But now look at their plan for 2026. They are ramping that up to a staggering $8 billion. This is not a company that's sitting on its hands. They are not tapping the brakes. They are aggressively stomping on the gas pedal, deploying an enormous amount of capital to buy new income-producing assets. That is how a giant gets bigger. That's how it fuels future cash flow.
But here's the thing. Anybody can go on a shopping spree and spend $8 billion. That's the easy part. The hard part is spending it profitably. The key metric you have to watch here is the initial weighted average cash yield. Some people call it a cap rate. But put simply, it's the answer to this question. For every dollar I spend on this new building, how many cents of rent will I get back in year one? A higher number is better. And the true test of a great team is keeping that yield high even when you're spending billions.
And this chart is where the bull case gets its strength right back. Look at this. While they were deploying record-breaking amounts of capital, they have consistently been getting initial cash yields well above 7%. In 2025, they put over $6 billion to work and still got a yield of 7.3%. This is hard proof that they are not just growing for the sake of getting bigger. They are not sacrificing their profitability for scale. This combination of massive scale and disciplined, profitable investing, that is the 1-2 punch that is going to drive future AFFO. And you might be asking yourself, well, where are they getting all this money? They're getting more and more sophisticated. They're not just issuing the same old stock and bonds, they are expanding their capital toolbox. They've launched a massive fund to bring in private money from big institutions. They forged a partnership with GIC, one of the most powerful sovereign wealth funds on the planet. They're expanding into new countries like Mexico, and they're using more complex, savvy tools like convertible notes. This is not some sleepy old landlord. This is a highly sophisticated, evolving financial machine.
All right. You've laid out a nice big picture strategy. They're spending a ton of money. They're getting creative about how they raise it. I get it. But bring it back down to earth for me and for everyone watching. For someone who's actually thinking about buying the stock today, what does all of this mean for the bottom line? Walk me through the actual financial blueprint for 2026. Show me the math. How do all of these moving parts, the acquisitions, the debt, the lower occupancy, how do they all add up to that final number?
Okay, let's build it out step by step. It's actually pretty simple. There's no magic here. So step 1, you start with their official net income guidance, which is about $1.67 per share. Step 2, you have to add back the huge non-cash expense for real estate depreciation. That's about $2.68. Step 3, you sprinkle in a few other minor non-cash adjustments, and just like that, you land right inside their guided AFFO range of $4.38 to $4.42. It's a clear, transparent roadmap to the only number that really matters. So we've done the work. We've laid out the bull case, built on scale and disciplined growth. We've examined the bear case, which is focused on that slowing internal growth and the massive debt. We've stress-tested the foundation, we've searched for cracks, we've analyzed the blueprint for 2026. So now it is time to put it all together and deliver the final iron financial verdict. Is this thing an impenetrable fortress for your portfolio, or is it a trap waiting for unsuspecting investors?
Okay, let's put it all on the table. The bull case, the fortress, is crystal clear. You have dominant, untouchable scale and incredibly high occupancy. You have a 30-year track record of dividend growth that is almost second to none. And you have a massive $8 billion investment pipeline running at very strong profitable yields. This is a powerful, disciplined giant. But the cracks are real, and you can't ignore them. The growth outlook for 2026 is, let's be honest, modest. The organic engine, that same-store rent growth, is hitting a plateau. That $30 billion debt load is a very real anchor. And the company itself is telling you that occupancy is probably going to dip a little. It feels like a very mature company whose best, fastest growth days are in the rearview mirror. Ultimately, this all comes back to your personal portfolio blueprint. Let's be very clear. Realty Income is not a high-growth tech stock. It is not going to double overnight. It is a slow, steady, compounding machine that is built on discipline and massive scale. So, if you are building a portfolio for aggressive, fast growth, this is absolutely not the stock for you. But if you are building a portfolio for durability, for consistent and slowly compounding monthly income, then this company's bedrock foundation still looks like it was built to last for decades. So the crucial question you have to answer for yourself is this: does that profile of slow but steady strength fit the blueprint of what you're trying to build? That's our analysis. Thanks for joining us here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.